Thank you again, everyone, for joining us today. I see a couple more people are joining in. We are lucky enough to have Colin Murray today, who is one of our members, our valued members. And as I was explaining, if you do have any questions, please do put those in the Q&A section. For those watching after this recording, go ahead and comment on the video area, and we'd be happy to get back to you with questions as well. Or answers, sorry, as well. So our speaker, Colin Murray, he is the founder of HighRidge CFO. He has previously held various high-level financial leadership roles, and he has a very acute understanding of small business challenges and develop strategies for these businesses so that they can grow and thrive. So I'm going to stop talking so we can get to who we really want to hear from, Colin. So Colin, it is in your hands now.
All right. Well, thank you, Kathleen, and special thanks also to the Chamber for giving me this opportunity to speak to you all this morning. I really do feel like I'm the lucky one here. Gets to share a little bit about some of the things I'm very passionate about, and that is how finance really can be a big strategic lever for small businesses. So, yeah, as Kathleen mentioned, what we're going to talk about this morning are five financial mistakes that could be holding your business back. Now, unfortunately, there are a lot more than five financial mistakes which can impact business, and for countless types of mistakes. And some of those are going to be specific to your business type, industry type, or where the business may be in its maturity life cycle. But what I'm honing in today and one are really more kind of foundational financial mistakes, which either solopreneurs, early stage small businesses, or small businesses who are just looking to put more maturity into some of their administrative functions and might want to be aware of. So moving on here, Kathleen mentioned founder and fractional CFO at HighRidge CFO, where it provides CFO services to small businesses. And just what is a fractional CFO? Well, it's simply a CFO gives part of their time to a small business or business who really doesn't need a full-time financial leader and staff. So work in conjunction with any bookkeepers, accountants that may already be employed by the business, or if there's any third parties they use. But then you working with them really help the business develop an end-to-end financial strategy so they're able to make decisions about their business, know what the financial outcomes will be. So we're looking at long-term planning, intermediate planning, shorter-term cash flow planning, and how you're going to finance your business, excuse me, both in the short and long term. One thing I do like to, excuse me, pollen's impact to me. One of the things I do like to make clear to really anyone I meet with, but certainly to clients and prospective clients I work with is, look, this has to be a living strategy, okay? Your finance strategy is not a one-time event. Your business will change, the economic environment will change. So this is something that you really have to live month in and month out. So why is this important other than me telling you that it's important? Well, unfortunately, your businesses come and go. And your business is of any size. Your startups, family-owned businesses, multinational corporations. There is just a general life cycle in businesses. Some stay around for a long period of time, some don't. Of all the small businesses that fail, just over 8 in 10 of those business failures could be attributed to the results of poor cash flow management. So this could be they're running out of cash really to support the day-to-day operations, or they're no longer able to meet their debt repayment obligations. But running out of cash is actually not the problem. It's a symptom of many other problems which span the entire finance process. So what do I mean by that? Well, your finance is a lot more than just doing your books. It's a lot more than just filing your taxes. Yes, those are a very key part of that, but there's a lot more that goes to that, which typically sits under the seat of a CFO in a larger established business. So the areas we're going to focus on today, I promised you 5 problems. I'm going to align one of those problems with each of these 5 areas. Accounting, internal controls, tax strategy, financial planning analysis, and finally, treasury management. So let's get started here. The first one, the first mistake I'm going to address here is mistake one, accounting not fitting the business, forcing the business really to fit accounting the other way around. Now, what I see with a lot of small businesses is, they may have an accountant, may have a bookkeeper, someone you're processing transactions. Think about your invoicing, your collections, your payables to your vendors, perhaps payroll, but they're not really getting a consolidated view of what that looks like on a recurring frequent basis. Instead, what they're doing is really looking at their numbers when it's time to file their taxes. They're getting one consolidated view of their financial statements, which is then used to file taxes, or if needed, when they're going out to a bank for loans, they just present you, they have this one financial snapshot. Now, if you look, accounting is the foundation of anything you do financially within your business. Those records collect the data which, if you structure it correctly, allows you to make a lot of decisions about your business and gain insights to things about how profitable you are in different areas. But in order for that to happen, you have to make sure that accounting structure is set up to fit your business. And so this means there's 3 areas that you need to be aware of. Your accounting records must be accurate, they must be timely, and they must support decision making. Now, accuracy hopefully speaks for itself. If your reports, your records aren't accurate, you could get yourself in a problem with the tax authorities. But most importantly, when you can't make good business decisions if your transactions aren't accurate. Timely. Now, this is an area where I see a lot of businesses struggling on, is they're looking at financials, maybe once a year, maybe quarterly, or if they do have someone preparing records for them on a monthly basis, they're not looking to say March results until the second or third week of April. And that's just too late. The business world, your businesses, they're not coming in 30-day increments. And it's continuously moving. You must have real-time visibility, perhaps not to 100% of the financial picture, but certainly the key drivers which are impacting your business, your revenue, your cash. If you're an inventory-based business, how much inventory you have in hand. So there are certain things which you want to measure your business financial performance on, you have to see more than once a month. The final one, supporting decision making. If you're a business that has multiple product lines, perhaps multiple locations, number of different customers, just one snapshot of your business just showing all your revenue, all your costs, and just one profit line is not going to allow you to make this business decisions. Think how you make decisions about your business, how you go to market, how you market to your customers, what products or services you're selling, the costs that go into those products or services. You need to understand your profitability. You need to understand the trends of those numbers. And if you've got different departments or different leaders within your business, they have to understand which areas of the business they're responsible for. So I'd ask you for this first one to really think about your business. Do the financial records you have really reflect how you make decisions in your business? If not, it'll certainly be time to take a look at restructuring that accounting structure. Second mistake number 2, is not having guardrails around your money. And this is the internal controls pillar. Now, I came into the workforce at the beginning of the 2000s, and this was not long after some of the large corporate frauds were making the headlines. Enron, WorldCom, to name a couple. And this led to the Sarbanes-Oxley Act being passed by Congress, which made large corporations implement a series of internal controls to combat fraud. Now, I had the not so fun privilege of having to go through a rotation of those audits when I was in my early analyst days. But it gave me a good takeaway. What was the importance of these? Yes, they're there to combat fraud, but they're also there just to put controls in place, just to prevent everyday mistakes. We all make mistakes. And those mistakes, the likelihood of those mistakes grows as your business adds more people, becomes more complex. So think about it for a second. If you think about your finances, your banking, who's having access to the banks, who's paying your invoices, who's collecting from customers. If one single person controls that entire workflow, that's a potentially risk for fraud, but also the risk for error if there's not a system set up for double checks. But then people come and go, right? People choose to leave the business, or if your business grows, you add more people. So being able to have standard operating procedures set up, so you've got all these things documented, including who's checking, when they're checking, how often they're checking. This is the kind of thing which will give you protection against the likelihood of fraud, but also just for general mistakes that may come up. I always like to say, look, if you're doing something more than once, if something which recurs, you should have something documenting, what it is, how it's done, who needs access, and really the step-by-steps they should be going through. Third one, as we're recording this today, we're just a couple of weeks removed from everyone's favorite day of the year, right? Tax day. Taxes are something which, like them or not, so that they're here and here to stay in one form or another. The challenge I see in a lot of businesses is not only are they just setting up their financial records really for the purpose of getting ready for tax filing. But when it comes to taxes themselves, they're thinking about taxes as just a once a year transactional event. And what I mean by that is, look, they know income tax filing day is the 15th of April each year. They may have a CPA they meet with who consolidates the financial records, files their taxes, gives some feedback as to what things they could be putting on there as itemized deductions to lower their tax liability. And that's great, right? You want to pay legally as little taxes as you can, but you got to think about taxes as something which is part of your financial strategy. What I mean by that is there are going to be business decisions you make which will have a tax implication on your business. As you grow, you might be investing in new facilities, new equipment. Those are the things you want to check in on throughout the year with your tax advisor to see what the tax implications of that may be. As you add employees, especially if you expand over the state line to another state, there's going to be different tax implications of that. As you look to grow your business, you might be looking at types of financing, which we'll touch on a little while down the road here. And the types of financing you use can have tax implications on your business. So what I really urge businesses to think about is that you need to integrate your tax strategy with your overall financial planning. These types of business decisions I just mentioned are going to have a tax liability. So having whoever is managing your financial planning internally, make sure that person is connected with your tax advisor, not just in the first quarter of each year as you're going about filing your taxes, but as you're throughout the year, have periodic check-ins so they can relay information to that tax advisor, say, this is what we expect about the business. This is the big decisions we have coming down the pipeline. This is where we think we want to grow, how we want to grow, what we're planning on investing in. So they can get that feedback from the tax advisor of things you might want to consider. And then you've got that fully integrated approach to tax strategy with your overall financial planning. Mistake 4. Now, this is getting into some of the areas which are particularly of interest to me. So mistake 4, not planning for multiple outcomes. This falls under what is termed as the kind of financial planning and analysis segment of finance. And broadly, before we go into this mistake, well, what is that? So the biggest mistake any business can make is not planning for the future. right? You're simply looking at your bank account each month, or you might have some financial records that tell you how you've done in the past, but you're not planning for where you're going to be 6 months down the road, a year down the road, 3, 5 years down the road. And that is just going to prevent any meaningful, profitable growth for your business. Financial planning analysis is a function within bigger companies which really focuses on understanding where you've been, what do the trends look like, how profitable where you are, um, how did you compare to expectations, prior periods, but then it looks forward too. And it looks forward really far out, 5-year plans, which are typically your high level strategic. Where do we want to take the business next? What big investments do we need to make to get there? What big hiring decisions do we have to make to get there? How are we going to finance the business to support that growth? Getting it down to a 1-year plan or budget, which is a little more detailed. What do we have to hit in the next 12 months? Who within the organization is going to be responsible for those goals? What metrics are we going to measure the business and those individuals on? And finally, how are we going to finance the next 12 months of operations? And then you break it down even more, where each month you're looking at how did the business perform over the last 30 days? How did we perform relative to the budget, prior periods? And then potentially even weekly, how are we progressing on certain key indicators throughout the month to make sure we're on track to the monthly targets. So that's really what FP&A is. It is really the planning and analysis of the business, both long term and short term. Now, what I see, and I've seen this in people I've worked with or people I've talked to, is that at some point in the past, they've been advised that you need a budget. And I agree, you need a budget. But they're under the false uh, belief that a budget enough is alone is enough for financial planning. And that's just simply not true. Now, what we just talked about is really kind of the whole financial planning cycle. Again, when we talked about long-term planning, intermediate planning, kind of the day-to-day management, the budget is just a part of that. That budget, that 1-year view, is simply just the first year of that 3 to 5 year planning cycle. So just looking at that doesn't really help you with kind of long-term planning, the big strategic decisions you need to make to get your business where you want it to go for the long term. Also, a budget is generally just a single point forecast. And what I mean by that is for 2025, say you're a business and you last year you did $2 million in revenue. You might think you're going to do 2.5 million in revenue at a 15% overall profit margin. So you've got a budget built up for that 2.5 million in revenue all the way down for your profit with your different cost buckets in between. That's great, right? You've got something to measure yourself on during the year. The unfortunate thing is the world does not operate under a single set of assumptions. And this is the case year in and year out. You're seeing it this year. There's a lot of noise in the environment right now in the economy around uncertainty on tariffs, but we're seeing it in other years too. We're seeing it with natural disasters. We're seeing it with the pandemic. We're seeing things which just come up, which are going to throw this completely off course. Now, they're not always going to be that extreme. But what you want to think about is, okay, we've got a budget, but what other potential scenarios could happen? And that's really where really one business is to focus on is prepare for multiple scenarios. And they don't have to be the extremes. But say your pipeline's really strong, you're getting a lot of leads, you're converting a lot of those leads, more than you expected. How will you cope with 20% additional volume growth this year? What do you need to start thinking about today to make sure you don't lose that potential growth? How is hiring today to support that? How can you finance that in the near term? Do you have enough cash internally to support that? What happens if your primary supplier goes out of business? Say their facility burned down. Do you have backup suppliers? If you do, what are their costs to you like compared to your primary supplier? If they're higher, How are you going to pass that on to your customers? Are you going to absorb it? So each of these different scenarios look at, yes, you want to get them down on paper and a financial model, but you need to make sure for each different scenario you look at, you've got actions lined out. So as each one comes to, it looks like it's going to come to fruition, you and your team internally within your business can start thinking about, okay, this is the scenario we planned for, or a scenario that most looks like the one we planned for. We know exactly play by play how we're going to go about to make sure we stay on track financially. Now, one good thing I will say about that, look, there is an infinite amount of different things which can happen, right? So you're not going to get bogged down in planning for 1,000 different scenarios, but you want to say this is our most likely one. These are the kind of the one or two higher end ones, and these are kind of the riskier ones. So you want to have probably kind of 3 to 5 different scenarios that your business is prepared for. Okay, the last mistake here. Mistake 5, waiting until you need funding. And this falls under the treasury piece of business. And the treasury function is simply just how do you pay for things and how do you have the funds to make sure you can pay for things. What I see is a lot of businesses who only think about financing when they need it. Okay, all of a sudden need a new truck for their fleet. We need to take out a loan for that. Or cash is a little tighter than we thought. We need a line of credit. And when you're thinking about kind of this last minute planning for financing, sure, unless your credit's completely awful, someone out there will provide you a loan. But if you're waiting to the last minute and trying to establish a financing relationship just as you need the transaction, you're going to pay a premium there. So what businesses really need to do is build a financing plan as part of their overall financial plan and make sure you're reviewing it regularly. Growth requires investment. If you're growing regularly, you're going to have to probably invest in that growth up front. Adding more people, adding inventory, building a facility, expanding a facility. And that investment may require external financing. So it's really critical that you understand your needs, your options, and your trade-offs. But most importantly, make sure you've got the right banking partners who understand you, understand your business, so they can be the best advisors to you as possible. So just to wrap that up here, I know we covered an awful lot of ground here in the last 20 minutes or so. These are the kind of the areas we focused on. One is that your accounting must be set up to support decision making. That is the foundation for everything else. You must have a fine accounting structure that supports how you want to make decisions in the business. 2, you're never too small to set up internal controls. In fact, it's going to be a lot easier to set some of those things up before you grow and before you get too complex. 3, integrate your tax planning with your broader financial strategy. Okay, taxes cannot be a one-time event. You need to plan for it. Analyze multiple scenarios in your business. The world doesn't operate under a single set of assumptions. And finally, make sure you identify your funding requirements before you need the funds. And I'll turn this back over to Kathleen here, but certainly my contact information's up on the screen, and happy afterwards to take any questions directly if you don't have them right now. So thanks again.
Colin, I can't tell you how appreciative we are for you to share all of that knowledge and advice and perspective with us. And you were getting all kind of messages to me saying great information. Thanks so much. So you really hit home, I believe, for a lot of people. Someone said excellent content and presentation. So thank you so much for sharing all of that. There is a question about when you go into a business, I guess you correct me if I'm wrong, but you'll go in and kind of decipher what's going on financially with them and then give them your best recommendations and you'll help them through that. Are there certain areas of spending that you see consistently that is an issue, whether it's marketing, HR, licenses, whatever that is. Is there one specific category of spending that seems to be an issue?
Yeah, and I'd say instead of more category, Kathleen, what I see is really people not understand the distinction between variable and fixed costs. Fixed costs are going to be ones which you're going to pay for month after month if your volume goes up, your volume goes down. And people don't really think about that. So these are going to be things like bringing on a lot more people before you have a need for it. So you're going to have salary expenses each month. These might be, leases. You're paying far more for space than you need, or you're buying like vehicles before you have the volume to come up for it. So you've got these fixed costs coming in. And these fixed costs, you may need them as you go down the road. The volume doesn't really pick up. You're still obligated to pay for that. So that's the biggest thing I see there is not understanding the distinction between what is fixed and what is truly variable with revenue.
Okay, another question. When do you know to get a loan? If you're looking to try to advance or buy equipment or invest into marketing, like when do you know it's time to pull the trigger and actually get a loan?
Yeah, so that's where it comes into kind of the planning. So the multi-year planning, but also kind of the budget planning. And this is where those kind of decisions you should be factoring in is, look, we need to purchase this your vehicle, this equipment, or we're going to invest in marketing at a certain point in time. And with that, you've got the expense factored into your financial model, and that's going to kick out whether you can afford to finance that with your cash internally. So you want to get ahead as far as trade as possible. But what you want to go with to lenders is why you need this, because they need to get a sense of how you're going to pay back. Okay, so if this is something that's truly going to generate more business revenue for your business, more profitability, you want to be able to share that information. And that's why it's important to really reach out, build those banking relationships ahead of time so you can educate those lenders on your business, your visions for it, and what these things are going to be. So as soon as you can, so you can start really that educational part of it.
And one last question. Since we are talking about small business and a lot of those are just, entrepreneurs owning their business and they're running it on their own, how often do you see their personal financial issues bleed into the business and vice versa? Or are they just kind of all the same?
Too often. Right. And I say this in a couple of ways, that there are things which are mixed between personal expenses, business expenses, and you really want those divided because if you're growing a business, you want to build a business entity that is separate from you, the business owner. So that you want as clear a picture as possible on what the actual financial view is for the business. But separately, go the other way. Like it's important for me as an advisor going in to understand what's important to the business owner personally, because they need to be able to diversify their wealth by taking cash out of the business. They can invest it with a financial advisor. You diversify some things away from the business. So I do ask that with my clients is, okay, how much are you taking out? Would you like to increase that? And we build that into their business financial plans. And so we make sure we know how much they can take out and when.
That is perfect. And look at us. We are right on time at ending. So, Colin Murray, thank you again for sharing all of this with us. I would suggest to reach out to Colin to explore how he can help your business and just get some structure to it financially and get a plan together because it's just seems like every slide was plan, plan, plan. So, that's what we need to do as business owners. And that's probably the last thing we want to do. So that's, Colin, that's why you come in and help us with that. So
Absolutely.
yeah, thanks again. Thank you everybody for attending. This is being recorded and you will see it on our YouTube channel. So please go ahead and rewatch it and share it as you wish. So we're getting another great job and all of it. So thank you guys and look for our next webinar, which is every last Wednesday of the month. We'll have a new presenter every single month. So thanks for attending and have a wonderful rest of the month.